Why do so many men look back in their later years with a deep sense of regret? The answer often lies not in what they did, but in what they failed to do. Wealth building is not just about money, it's about choices, habits, and discipline. Today we're uncovering the 10 wealth-building lessons men learned too late in life. Lessons that, if acted upon now, could transform your financial destiny. Are you ready to stop making excuses and start building a legacy? For generations, the pursuit of wealth has been synonymous with success, security, and freedom. Yet, despite our modern access to financial information and tools, many men find themselves trapped in cycles of debt, missed opportunities, and financial stress. Why is this so common? Because most men are never taught the principles of wealth building. Or worse, they learn them when it's too late to make a difference. This video is a wake-up call. It's a call to action for every man who dreams of a life beyond paycheck-to-paycheck living. Whether you're just starting your career, building your family, or reflecting on missed opportunities, these lessons will resonate deeply. Let's not just talk about money. Let's talk about creating a life of abundance, purpose, and impact. Lesson 1. The power of compound interest. One of the greatest regrets among men is underestimating the magic of compound interest. Einstein famously called it the eighth wonder of the world. Compound interest is the concept of earning interest on your initial investment and on the interest that accumulates over time. Here's the kicker. The earlier you start, the more exponential your growth. Imagine investing $100 a month starting at age 20 with an average annual return of 8%. By the time you're 60, you'd have over $300,000. Start at 30, and that figure drops by more than half. The beauty of compound interest lies in its ability to amplify even modest contributions. It's not about how much you invest, it's about how consistently you do it. Men often underestimate the cumulative power of small actions over time, forgetting that wealth is built brick by brick, not overnight. Consider the story of two friends, John and Mike. John starts investing at age 20, contributing $5,000 annually for 10 years, and then stops. Mike starts at age 30, contributing $5,000 annually until age 60. Despite investing less, John's early start means he ends up with more money at retirement than Mike. Delayed gratification is hard but essential. Overcoming the temptation to spend in the short term can lead to incredible rewards in the long term. Beyond basic investing, explore avenues like index funds, ETFs, and reinvesting dividends. A diversified portfolio reduces risk and maximizes growth potential. Start investing today, no matter how small the amount. Utilize tax-advantaged accounts like IRAs or 401ks to maximize your returns if you live in the United States or something similar in the country where you live. Automate your contributions to ensure consistency. Seek professional advice if you're unsure about where to begin. Lesson 2. The real cost of lifestyle inflation. As income rises, so do expenses. This phenomenon, known as lifestyle inflation, is a silent wealth killer. Many men increase their spending as their earnings grow, falling into a trap of perpetual financial stagnation. Lifestyle inflation often stems from the need to keep up with the Joneses. Men compare themselves to peers and feel compelled to upgrade their homes, cars, or wardrobes to match. This mindset leads to a never-ending cycle of consumption, leaving little room for savings or investments. Consider this. A $5 daily coffee habit adds up to $1,825 a year. Over a decade, with a modest investment return, that's over $25,000 lost to fleeting indulgences. Now multiply that by larger expenses like luxury cars or excessive dining out, and the opportunity cost becomes staggering. Societal norms often pressure men to equate success with material possessions. Breaking free from this mindset requires self-awareness and confidence. Retail therapy and impulse purchases provide short-term satisfaction, but long-term regret. Understanding your emotional triggers can help you avoid unnecessary spending. Look at the broader implications of consumerism. Excessive spending fuels debt cycles and economic instability, both personally and globally. Live below your means, even as your income grows. Differentiate between needs and wants. Funnel salary increases directly into investments. Set tangible savings goals to counteract unnecessary spending. Lesson 3. The importance of multiple income streams. Relying on a single income source is a risk many men realize too late. Job security is a myth in today's volatile economy. The wealthiest individuals often have at least 7 income streams, ranging from investments to side hustles. Active income from your job, passive income like rental properties or dividends, and portfolio income from investments. Entrepreneurs like Elon Musk and Jeff Bezos didn't rely solely on one venture. Diversifying their endeavors allowed them to weather failures and capitalize on opportunities. Explore common avenues for diversification, such as freelancing, online businesses, or investing in peer-to-peer lending platforms. Each stream, however small, contributes to your overall financial stability. Develop skills that can translate into freelance or consulting opportunities. Invest in dividend-paying stocks or rental properties. Explore passive income opportunities, such as writing a book or creating an online course. Regularly reassess and optimize your income streams to ensure they align with your financial goals. Lesson 4. The pitfalls of debt mismanagement. Debt isn't inherently bad, but mismanaged debt is a wealth destroyer. Men often fall prey to credit card debt, high-interest loans, or financing depreciating assets. Good debt, like mortgages or student loans, can enhance your earning potential or net worth. Bad debt, like credit cards, drains your resources without adding value. Debt can lead to stress, strained relationships, and poor mental health. Recognizing its true cost goes beyond interest rates. Beyond interest, consider the opportunity cost of carrying debt. Every dollar spent on interest is a dollar not invested in your future. Avoid unnecessary debt, especially for luxury items. Focus on paying down high-interest debt first, the debt snowball or avalanche method. Use debt strategically for appreciating assets, like real estate or education. Create an emergency fund to avoid reliance on credit during financial setbacks. Lesson 5. The value of financial education. A lack of financial literacy keeps men trapped in cycles of ignorance and poor decisions. Understanding concepts like asset allocation, tax strategies, and investment vehicles is non-negotiable for wealth building. Financial education is often overlooked in schools, leading to generational cycles of poor money management. Apps like Mint, books like The Millionaire Next Door, and online courses can bridge the knowledge gap. Knowledge without action is useless. Apply what you learn through small, consistent financial decisions. Read foundational books like Rich Dad, Poor Dad by Robert Kiyosaki or The Intelligent Investor by Benjamin Graham. Follow financial thought leaders and credible sources. Commit to lifelong learning. Financial education doesn't end. Share your knowledge to empower others and reinforce your own understanding. Lesson 6. The role of risk in building wealth. Many men fear taking risks, preferring the illusion of stability. Yet all significant wealth building requires calculated risks, whether it's investing in the stock market, starting a business, or buying real estate. Fear often stems from a lack of knowledge. Educating yourself reduces uncertainty and builds confidence. Playing it too safe can lead to missed opportunities and stagnant growth. Not all risks are equal. Learn to differentiate between reckless and calculated risks. Diversify investments to spread risk without compromising growth potential. Lesson 5. Diversify to protect your wealth. The old adage is true, don't put all your eggs in one basket. Diversification is essential for safeguarding your wealth. Too many men place all their faith in one investment or one source of income, believing that a single victory will set them for life. What happens when that one investment crashes, or when your job is eliminated? You lose everything. That's why diversification is crucial. The wealthiest individuals have their money spread across different assets: stocks, real estate, startups, and increasingly digital currencies. In cryptocurrency, diversification means not just investing in one token, but understanding how to spread your risk across different technologies: Bitcoin, Ethereum, Polkadot, Cardano, and others. Every cryptocurrency has its own potential, its own use case, and its own risk profile. Learn to balance your portfolio. Lesson 6. Don't wait for the perfect time. How many times have you heard men say, "I'll wait until the market stabilizes," or "I'll invest when the time is right"? This is the trap of waiting for the perfect moment. The truth is, there is no perfect time. You will never have all the information, all the certainty, or all the confidence you think you need. The key is to take action in spite of the uncertainty. Cryptocurrency, again, is the perfect example. Early investors didn't wait for Bitcoin to hit $50,000 before buying in. They bought it when it was worth pennies. And those who waited for the perfect time to jump in have missed massive gains. Waiting for perfect conditions leads to missed opportunities. Take action now, even if you're unsure. Lesson 7. Learn to control your emotions. The market, whether it's stocks, real estate, or cryptocurrency, is an emotional roller coaster. The highs are exhilarating and the lows can feel crushing. But how you respond to those emotions determines whether you're wealthy or just another casualty of the market. Men often make emotional decisions when they're scared, excited, or frustrated. They sell when the market dips, or they buy on impulse when things are booming. Wealthy men, however, know how to detach from their emotions and make decisions based on logic, not feelings. In cryptocurrency, this is vital. The volatility of the market can drive you to panic, but the key is staying calm, analyzing the data, and sticking to your long-term plan. Emotional control is your weapon for surviving and thriving in the world of wealth building. Lesson 8. The importance of networking. It's not just about what you know, it's about who you know. The wealthiest men surround themselves with other successful people. They build networks of mentors, advisors, and like-minded individuals who can help them scale faster, avoid pitfalls, and open doors that would otherwise be closed. Networking in the world of cryptocurrency is no different. Many of the most successful crypto investors didn't just act on their own, they leveraged connections, learned from others, and gained access to exclusive information. If you want to build wealth, you must surround yourself with those who are already where you want to be. Lesson 9. Focus on value, not price. Too many men are obsessed with chasing the next big get-rich-quick scheme. They focus on price rather than value, thinking that low prices are always the best buy. But value is what truly builds wealth. Look at the success stories in cryptocurrency. Those who focused on the value of blockchain technology and its real-world applications saw massive returns. They didn't chase after the next token with a low price. Instead, they saw the potential of decentralized finance, NFTs, and other blockchain innovations. They understood that value is what endures, not short-term price fluctuations. Lesson 10. Invest in your health and mindset. Wealth is not just about money. It's about having the energy, the mindset, and the resilience to continue striving for success. If you neglect your health, your wealth will eventually crumble. A fit body and a focused mind are the pillars of long-term success. Many wealthy individuals, crypto millionaires included, invest in their physical and mental well-being. They prioritize exercise, nutrition, and mental health because they know that their greatest asset is themselves. Without a strong foundation, no amount of money will matter. Whether you're 20, 40, or 60, you can start today. Take control of your time, your investments, your mindset, and your health. The road to wealth isn't easy, but it's worth it. The question is, are you willing to take the first step? The choice is yours. I hope you enjoyed this video. If you did, please show your support by hitting that like button and subscribing to the channel. Sharing this video with your friends would also mean a lot. I'd love to hear your thoughts in the comments below. Your feedback helps me create even better content. Thanks for watching, and I'll see you in the next one.